All right. Hi, everybody. Long time no see. This is Katelyn Kriesel, co-host of SustainaFi, the Sustainable Finance Podcast. And I am here with Thom Delwo, my co-host. Thom, would you like to say hi to everybody?
Hi, it's been so long.
I
Nice to see
know.
you, or not see you, but be seen by you.
And during this beginning part of the podcast, I always want to say good afternoon. And then I'm like, what time? I don't know what time people are listening to this. So I always have to remind myself not to say it, but no, I've already said it anyway. So Thom, do you want to introduce what we're going to be talking tonight about this afternoon, this morning, this evening, whenever it is people are listening to this? And because you're driving the ship here today.
Yeah, so to like preface all of this, right? So Katelyn was like, we have to do a podcast, and because we haven't done an episode in a long time, which is true. And I was like, yes. And I've been thinking about this concept in economics called rent seeking, which is what, and I was like, let's talk about that. And she was like, fascinating. I don't know if she was being facetious or not. But then she was like, let's, so she did some research, I did a little research. And the bottom line here is that, this idea of rent seeking, the concept of rent seeking is earning money, but creating no value. And it goes actually, the concept goes all the way back to Adam Smith and The Wealth of Nations. And I'll just read you a quick quote to give you kind of an overview. This is from The Wealth of Nations. So it's a little antiquated, the wording, so forgive me, but as soon as the land of any country has all become private property, the landlords, like all other men, love to reap where they never sowed and demand a rent even for its natural produce. The wood of the forest, the grass of the field, and all the natural fruits of the earth, which when land was in common, cost the laborer only the trouble of gathering them, came even to him to have an additional price fixed upon them. He must then pay for the license to gather them, and must give up to the landlord a portion of what his labor either collects or produces. This portion, or what comes to the same thing, the price of this portion, constitute the rent of the land. So essentially what Adam Smith is saying there is that you can get into situations in capitalism whereby folks own some sort of asset that's necessary for everybody, or generates valuable resources for everybody, and they just kind of sit on it, hold it, and say, you got to pay me if you want to use it. And this was something he cautioned against. He felt like this was not a good thing for an economy. And I feel like more and more in our current economy, this is what we're seeing. We're seeing concentration of resources into the hands of the few. We're seeing situations, where wealthy people continue to make money simply because they have money, right? With no or very little risk on their part. And so that's kind of the concept I wanted to talk about today. And because our podcast is about sustainability, and as more and as income inequality grows, you're going to get to a situation where there are very few people have all the wealth, everyone else has very little, and that's not good for society, right? And I think that's showing itself in a lot of ways.
Yeah, it's an interesting notion, because if you think about this in kind of present day terms, one of the core conversations that we talk about in our community, we live, of course, Thom lives in Syracuse, I live just outside of Syracuse, New York, and the discrepancies in wealth between communities of color and white communities it's certainly around the country. It's so profound and it's so significant. But in Syracuse, we live in one of the most racially segregated and economically segregated by race communities in the country, which a lot of people don't realize. Syracuse has this claim to fame, certainly not something to be proud of. So how do you solve this problem if the wealth that is we know that wealth is inherited? I'm a financial advisor. As a financial advisor, I know that wealth, most of my clients that come to me and have wealth, they didn't earn it by working. They earned it, or they didn't earn it. They inherited it from a parent. And that parent might have worked really hard But now that money, it's not being earned in the economy, it's being inherited, and it's mostly being inherited by white people from their white parents. So how do you break that system so that, I mean, if we live in the land of the free and everyone has a chance to work really hard and make it if you just try, how can you do that if most of the wealth is being passed on from generation to generation and is locked up in predominantly white families and white communities?
Yeah.
Uh,
Yeah.
I was reading an article about it was no, it's a systems book I just bought, and I'm only a few pages in, but it was suggesting that the system is broken because the money can't be earned; it can only be inherited. So it is interesting. Yeah.
Yeah.
Is that similar to what you're referring
Yes.
to?
Yeah.
Okay.
Yeah. Absolutely. Yeah, that's right. And the you know the it only goes one way, right? So when you the money accumulates in the hands of the people who already have money, right? So it only gets bigger, so what that does is it just stretches inequality, right? It makes if you imagine it as like a society, a very top heavy society where the resources are in the hands of a very few, and you're right, like the question you ask is exactly right. Like, how do you break that cycle when the accumulation leads to more accumulation, which leads to more? It's like a snowball, like an avalanche.
Well,
right?
and it's getting worse every year. The wage gap gets worse every year. We know that. I just jotted down quite a few notes because this, whatever it was that I was reading, I'll see if I can find it and I'll post it, because perhaps it wasn't this book I'm thinking of, but it's reminding me of something I just read in the last week. And another thing that it mentioned was college, like going to college. It's very difficult for people who are low to moderate income, or I don't want to say that they are low to moderate income, but their assets are, their wealth, their income levels are lower. To be able to afford to go to college and stay in college and feed yourself and pay for your dorm and pay for your books, you have to have money to do that. And one of the partners of our organization is On Point for College. They are trying to break down that barrier simply by providing like the $50 registration fee. Something so small. If you don't have $50, you can't pay it. You can't go. After all the hard work you did in school, it's not about how smart you are. It's about having $50 and about having someone that can drive you. On Point for College will drive kids to their college classes, to wherever their school is, and help move them in. And if they can't afford textbooks and they don't have, and the school doesn't give money to them for that, then they can't go to college. So it's not about how hard you work. It's not. It's about having someone who can afford to pay for it for you. And if you don't have a parent who can, or who is unable to or unwilling to, then what do you do? What do you do? On Point for College can't help everyone, which means that the people that are going to school and staying in school and graduating from college, and who would then have an increased likelihood of increasing and improving their ability to earn money, is falling again to the kids who are coming from privilege, and they don't even have to worry about working part-time because their parents are paying for everything. And I consider myself one of those people, and I feel very lucky. So then the question is, how do you fix the problem, right? And there's the old adage, like, it takes money to make money, right? And so for me, Thom, this is where you come in and Cooperative Federal comes in. And I listened to I watched a really incredible webinar with all these people from different impact investment spaces, talking about CDFIs, community development financial institutions. Do you think that organizations like yours can help to play a role in solving this? Because you are giving money to people who need it, right?
Yeah, I do think that I do feel that way. I mean, one of the hard parts about at least credit unions in that space is that community development credit unions and low-income designated credit unions like Cooperative Federal, what do we reach resource constraints because the vast majority of resources that we have come from the savings, the tiny little savings that folks are able to scrape together and put into a savings account. And so, we, understandably, like, because the nature of our business is that we serve a population that doesn't have a lot of savings, and therefore that limits the amount of savings we have to deploy as loans, right?
Right.
How do we overcome that? Well, we overcome that with, like you said, impact investing, like whether it's through foundations or philanthropies, people can, or the government, people can invest through us, and then we can lend more than we actually have in savings. But I think that's, and that's something we've talked a little bit about before, is, this reliance on generosity, the generosity of the wealthy.
Yeah.
So like, that's where foundations get their money, that's where,
So you circle right back around that the power is in the hands of,
right,
of wealthy, predominantly white people. And so you and I were talking over the last couple weeks or months probably about jobs in this field, that like, what job can you have that allows you to have the most impact? And so I really dug in deep, because I was really reevaluating professionally, like, what is out there. And I went down many rabbit holes, and I found myself asking this like very existential question about my career and my field, the field we are both in. Like, what's the job that allows you to have the most impact? And as a financial advisor, I am financially incentivized to work with the wealthiest people I can find.
Yeah.
I'll make way more money, but I have decided that I don't very much care, as long as I'm making enough money to live a nice life and provide for my kids. I would rather help people. So I think that having access to a financial advisor should be a fundamental human right. If we're living in a capitalist society, and everyone says that you too can build wealth, you just have to be smart enough and work hard enough, but then we're not connecting them with the tools to do it, then I think that's pretty hypocritical. So if we're going to make everyone live in a capitalist society, fine, but we should be providing them with the resources that they need to solve these problems.
Yeah.
But I thought, am I really having an impact as a financial advisor working with one person at a time, helping them to just put $50 a quarter into the stock market? Will that really help them to build wealth? Am I really helping them to solve their problems? Am I helping to solve the issues that capitalism has helped to create? So I was really backing up and asking myself that question. And so I was looking at job opportunities working for multi-billion-dollar family foundations, hundreds and hundreds of millions of dollars family foundations, where they are deploying wealth to historically marginalized communities through CDFIs to help to solve this crisis that communities around the country are in, including our own. And it just seemed so antithetical. What's the word?
Antithetical.
Antithetical, thank you, to my belief system. Like I feel like I am, like, if the way to fix the problem is to go and find the wealthiest people in the country and get them to invest in CDFIs to leverage capital in historically marginalized communities, then I think we have a problem with the system, if that's the only way to solve the problem. And so then I ended up kind of right back where I started. I was like, I should start a nonprofit that's helping to solve the systemic and systematic crisis.
Yeah.
Oh, and I already have one of those. And so
that's super interesting to me, that you went through that, that like crisis and thinking and thought process. Because I think, you came back around to it again, right? Like, let's say you started that 501c3 and you were like, who would your market for funding be, right? It would be those same wealthy foundations created by, and so I think it's so hard. It's such a tricky thing. I mean, so I just want to go back to the college analysis or college analogy that you made. So, one of the things that I was and this also ties into rent seeking, in that, like, there's been a long march at a governmental level, at a federal level and a state level, towards reduction of taxes, like not taxing large and why does that happen? It happens because of lobbyists, right? So corporations, and that's one way that corporations, especially large corporations, kind of control their market space, make sure that they shut down competitors, they make sure that the government is not, taxing them too much. And they do that through lobbyists, and that's a form of rent seeking, right? It's like, how does Facebook stop competition? Well, they just buy them, right? And they shut them down, or they incorporate them, right?
Yeah.
And so you get larger and larger corporations that have more and more control. So that's a really bad thing. And one of the consequences of that lobbying effort has been a reduction in the funding for state colleges and community colleges. And what it's shifted to, instead of getting funding from the federal government. So like back in the 70s, it really was a realistic thing for you to go get a summer job, right? Work through the summer, save up enough money, and then put yourself through college, year by year, right? And then it's gradually shifted through also lobbying from financial services to, well, don't worry, yes, people are being, college students are being asked to share more of the burden, but it's okay because we'll fill that gap with student loans. And so who benefits from those? So how do you, instead of leaving college with no debt, with a degree that's going to actually do something, in terms of, making you help you build wealth, you leave school hopefully with a degree, but definitely with debt. And so, it's, as we move more and more towards this sort of, and we've talked about this before on the show, this sort of individualistic mindset, like, you're on your own, the government, it's partially because of this concept of corporations deciding to, push government out of the picture. And what's left behind? Debt and private philanthropy, right? Those are your two sort of options, if you want, and it really ties your hand, like, not ties your hands, but like, what do you do? How do you overcome?
That's interesting. Like, one of the things that I've been thinking about a lot more recently are the roles that corporations play in the United States, and that there are a lot of people who are very much like, I would say, they would say they're for small government, but like, they're really against government. They think that government is taking something away from them. And so I've found this very interesting, that like, for me, my philosophy on government is like, government, especially in a democracy, is theoretically supposed to be the culmination of all the people. So if you hate government, like, you are the government is you. And so if you're advocating for small government, the argument is that you're leaving more money in the hands of the people who have earned it. They're not taking as much from you.
Right.
But as corporations have gotten bigger and bigger and bigger and pay so little in taxes, and small businesses are taxed. I own my own business. I pay a lot in taxes. It's really crazy how much of my money goes to taxes. So it's like, no, I don't want to be paying a ton in taxes, because I did earn my money, and it's difficult for me to pay my bills when so much of my income goes to taxes. But if corporations are so big, that's not money that's in the hands of the people. That's money that is in the hands of the few. And
a very small group of people.
A very, very small. The percentages, like, we know, like the 1% or whatever it is, far less than that probably. And then they're so generous, they donate it. Like, this is such a big problem.
Right. And the concept is, don't tax us and tell us and give our money to the government so that the government can decide what to do with it, or the people can decide what to do with it through the government. We will give our money voluntarily. But what does that say? That says, like, they get to decide where the money goes, right? So it's like, it's not democratic, right? It's not
right. Right.
Don't tax our money out of our hands. We'll give it to you, but we'll give it to you in the areas we want to focus.
Right. This is so interesting. And it's because if we're in a democracy, like, I was going for a run the other day, and it's just, if corporations have so much power and they have so much of our country's wealth, and they have so much money, like, they pay, some of these executives are making just $500,000 a year to just to do what? Like, to do what? And so like the argument is, well, you can go have it. I worked hard and I got it. You can go get it too. But that's not true. We can't all go do it because someone has to drive the school bus. Someone has to do Instacart. Someone has to mow the lawns. And like, if you want those things to be done, but you're not willing, then pay that I'm like throwing my pen, pay them $500,000 a year to do that. Because if you want those things to be done, but then you also want everyone to work really hard to become middle management and make $250,000 a year. It's nonsensical. And I do feel like this conversation could just go in a loop because it is cognitive dissonance. It doesn't make any sense. It's not democratic. And at the end of the day, ESG, so this was a big part of this question as well, is being a financial advisor that does ESG investing, screening, and investing my clients in companies that meet a minimum criteria for their corporate social responsibility. Is that good capitalism or is it just capitalism? And
I mean, I don't, so sorry, I don't want to cut you off, but
no, you can go ahead. I think I was like wrapped up anyway.
So one thing that I will say for ESG, right, is that at the very least, it takes the focus off of profit, solely profit, right, and puts it on the bigger picture. And so because, by encouraging companies to evaluate their ESG impact, you're moving in the right direction. So I wouldn't, I don't want to throw all of that away. I think a lot of that is really good work. I think one method of maybe moving us even further along is to kind of put some teeth behind ESG. So to say, because right now it's really just voluntary, right? Like companies can choose to do it or not.
Right.
In the same way that giving is voluntary, right? And so I think one way to address that might be to say, like, governments created corporations, right? So governments can change the way corporations are formed. Governments can say, can give preferential treatment to corporations that meet criteria. I feel like governments can do all kinds of things to rein this back in, beyond just like increasing taxes, right?
Yeah.
Which we can argue about whether that's a good thing or a bad thing. And there,
I feel like we should have a whole episode on trickle down economics at some point.
Yeah.
Dad.
Hi.
Hi.
Can I have some Valentine's Day candy?
Yes, you can have some Valentine's Day candy. When making a podcast and your son comes in and asks for Valentine's Day candy, the correct answer is yes, you can have it.
My kids have learned that if they want anything, they have to ask me while I'm in a meeting, because I'm just like, yes, just go play the Xbox, because they know. They're like, can we just, I'm like, stop miming to me, and I'm just like, whatever you want, and I'm gesturing to them off camera because everything's in Zoom. So this has become my life. For us, it's screen time. It's all.
So I'm interested in what answer you came up with in your existential crisis. Like, what did you decide? Are you still in it?
I think it's a question I'll always ask myself, because I do think the system is broken. And what I felt encouraged by was, I felt like the job that I have is as good of a job as any. And if I had to pick up any of those jobs, I would pick my own, because I love working with my clients. I do help people to save money and to make good financial decisions. And there are not a lot of financial advisors willing to work with people who are who have LMI, who have low to moderate income. So I felt like it was more important for me to be on the ground doing that work than for me to go work at some big family foundation where I'm steering money to things like this, but you're so far removed from it. I thought there needs to be people on the ground doing this work and building this movement up from the ground up. And so I am looking at all of the boards of these organizations, and there's a lot of nonprofits advocating for the democratization of impact investment, so that it's not just the big family foundations who can do this, but democratically we can be supporting CDFIs through impact investments. I thought that's what I want to do. I want to stay in my role, but I want to be I want to be helping to create more investment opportunities for people so that when you're putting money in your retirement plan, when you're saving money for your kids' college, there are investment options available to you that are not going to corporations, but are instead going to essentially to CDFIs. I think CDFIs, more and more, it's becoming clear to me that there is a return on investment there, and that is the truly the best place to have the impact. And this webinar I attended that I sent to you, I think I did.
You did, yeah.
They were saying that in the Biden administration, they're expecting to see CDFIs really get more support. That in the pandemic, that those are boots on the ground. These are the entities that are getting money into the hands of the people who need it the most. And so that's so important. So if I am a financial advisor and I'm working with clients and I'm helping them, I can also be leveraging that role to demand that products like this get created, and to hopefully in the future, I've already put out some feelers to some people in the industry to say, this is what I want to do. I want to serve on a board of an organization that's doing this type of work. And it would be really interesting to see if we could set up in Central New York our own impact investment. So that, because you even mentioned it earlier, your organization is relying on what? Two things: savings and generosity from private foundations.
Yeah, and the government.
And the government, right.
Yeah.
So 3. So what if there was a fourth that was a democratically available impact investment that anyone in the country could buy shares of? And they were willing to accept a reduced rate of return, because people, they don't necessarily want to give their money away and have it be gone forever. They want to be able to get it back someday, but a lot of people don't necessarily want to grow that asset either. They've got enough money they don't need anymore. They don't want to invest it in the stock market. It's just sitting in the bank. They'd be happy to put it into an investment like this. And there is a fund in Boston that is that's similar to what I'm describing, and they're doing it on their own. Like they're taking the money and then they're lending it out to businesses and different entities. I think the more powerful thing, in my opinion, with knowing very little about this, is that the fund would support home headquarters, cooperative federal, other CDFIs. And I asked that question in that webinar, and it's difficult to set those things up for smaller organizations like yours, but that's where I had lunch with my friend from the Community Foundation, and we talked about how could we do something like this, because there's so much wealth in people. It's not even necessarily relying on the generosity of people. I have some clients who've inherited money, and that it's they didn't want it, but it's theirs and they have it. And they don't want to just put it in the stock market to grow it. They really want to leverage it to affect change. And it's not that easy to do. They're not multimillionaires, but it is several $100,000. They're young, they're working, they don't need the money right now. So they would be willing to do something like this if it were more available. And there are organizations. Have you heard of? No, go ahead.
I was just gonna say, it's hard for you to advise somebody to purchase shares of that, right? Because of the SEC regulations.
Yeah. So if we could create, like, I wouldn't necessarily be able to recommend to my clients that they purchase shares of something like that, because it would be considered selling away.
Yeah.
So the aim over the long term, I'm 33 years old. The idea would be that something like that should be able to be purchased in your brokerage account with your financial advisor. So like closing these just administrative hurdles more than anything else. Like right now you can buy like the Calvert Impact Note, and I'll put my caveat here that past performance is not indicative of future results. Cadaret Grant is my broker dealer. They love when I say that on the podcast, so I'll say it again here. And, but I think that there will be more opportunities. There is the Calvert Note available at a lot of broker dealers, but most don't offer very many. So we need more available, and it needs to be democratic so that we're not just, right now, the only people who are really funding impact investments are people with hundreds of millions of dollars, because they're able to create their own investments.
Right.
So it's, again,
and say what the name for those types of investors are.
Accredited.
And why are they special?
They're special because they either earn, I think it's $250,000 a year for an individual, and then it's like 300 for a couple or something like that. So they either have to be earning a certain amount of money or have, I think, $1 million in net worth.
Right. And what that means is that the SEC says for some reason they're smart enough because they're making lots of money. So they have lots of money. So they're smart enough to make riskier decisions.
Well, I think that if you were to ask, they would say that they're protecting people that don't make a lot of money from financial advisors or from financial advice that is too risky for their net worth, that they don't have the risk tolerance. So you're accredited, not because it does sound like you're smart, like they think that you're smarter. But then it's like, who are they really to decide if you're, but this did change. The Department of Labor did rule on this a couple years ago, and that was what allowed crowdfunding. To do crowdfunding, you used to have to be an accredited investor. That's not the case anymore. Mm-hmm. There was a ruling from the Department of Labor, and if we had like a producer, I'd yell to the producer right now to search it up and tell us what it was. Yeah. But I believe it was like 2015 that they made the ruling, if I'm remembering correctly. And why does the DOL, why does the Department of Labor get to do this? It's pretty confusing, but I assure you it is the DOL that did this.
I believe you. I guess the reason why I pointed that out is because I agree. I don't disagree necessarily with the SEC's decision that somebody who has only $100,000 can less afford to lose a big chunk of that money than somebody who has $1 million, right? I get that. I've always been a little snarky about the name, the accredited investor name. I don't know.
There are things that I cannot sell to people if they don't have enough money. They just go, I'm not allowed to. You have to be accredited. And there's a certain type of REITs. And there's I was looking at another elaborate scheme this week, which it wasn't so elaborate and wasn't even really a scheme. It was just an investment option. And I won't get into the details of it. And they have millions of dollars, but they didn't have enough millions. You needed 5 million to do it. And so you just didn't qualify. And so the thing that I think is at the heart of this discussion is that there is this theory in the United States, this theory of America, that if you just work hard enough, you can get there. But what we've been able to identify is that there's a lot of people who got there by not working at all. They just inherited a bunch of money. And that working really, really hard. I know a lot of people who are really, really hard, but they can barely keep up with their bills. And they're certainly not building wealth, because to build wealth, you have to be earning more money than you need to spend. And the minimum wage isn't even a living wage in this country. So how, if you really believe that America is about working hard and you can make it, and I say working with no G at the end because I feel like it really needs to lack a G, then you need to be supportive of an increase in the minimum wage. Do you know what I really found interesting was one of the proposals that I saw, that they're going to start taxing companies that don't pay their employees a living wage, because they're paid so little. All those people are on public benefits like food stamps and everything else, and could never possibly afford to get ahead. So those businesses are subsidized by the government, because the government is helping to financially support all of those people who, if they weren't, would not have enough money to feed themselves. It's ridiculous. So I was like, well, that's interesting.
And wouldn't have healthcare for sure. I think, I don't know. I think the thing that I keep coming back to with this big, and I like the way that you kind of framed it with, this concept of America and who we are as a nation and the American dream, like this whole idea. I really like, I really feel like there was a time period in the United States when that was more true than it is now. That you could, that there was more opportunity, and maybe we should do a show about trickle down, but there was more opportunity to, go from, not rags to riches, but rags to stability, right? Like,
yeah.
And that changed, and I think a lot of that has to do with, the push from corporations and from the right to a great extent, away from, funding government and towards, letting sort of encouraging everybody to just sort of figure it out on their own, and making it much more difficult for people to actually move up. I mean, economic opportunity, this country is supposed to be about economic opportunity. It's supposed to be about giving people the ability to move from where they are to a better place. And that is just harder and harder and harder to do. And so, I said it before and I'll say it again, like, I don't know, how do we reverse this? Because I think in the long run, if we don't reverse it, it will result in a major fracturing. I think that the fracturing of this country that is happening right now is largely due to many people feeling like they've been screwed over, and they're not quite sure who screwed them over, but they've been screwed over and they're really pissed off, and they they don't have what they need, and that's going to cause really bad things. That's.
I think we're seeing all those really bad things already, and I feel like this notion of rent seeking, right? It is inherently extractive, and this is something that's just blown my mind since I was a little kid. That polluting the oceans, polluting the air, digging and scarring the earth to dig rock out of it, and permanently destroying that piece of land because it had value and you owned it and it was yours to destroy. And that, I mean, have you ever seen the movie Spanglish? It's a really cute movie.
I have not, but
it's got Adam Sandler in it.
Adam Sandler, right? Yeah.
And then, but he's like, it's a dramatic movie, so it's like he's funny in it, but it's like more of a drama. He's really, I think, unappreciated in his time.
I agree.
There's this part where a younger Hispanic girl says that she didn't know natural resources could be privately owned, because here was the beach, but it was on the other side of all of these private properties. And so here we all inherit this planet. We're all passing this planet on to future generations, but do we? Who owns the planet? Yeah. I can't go to that beach because I'm not rich enough. I'd have to be a multi-millionaire to have access to that beach. And there are not that many public beaches available, and they're swamped with people because we're all stuck there because none of us can afford what was supposed to be a resource that was available to everyone. We're locking up natural resources, and we're polluting our natural resources and decimating our planet, all because someone owns that piece of land, so it's theirs to destroy. That's ridiculous. Yeah. And we're not going to have a planet, and that's been happening, and it's continuing to happen right now, and it turns my stomach. So, I mean, if capitalism is inherently extractive, then, and it's all about someone saying, this is mine and I'm going to make money off it and I own it, and there's very little you can say or do about it, then how democratic is it really? How democratic is it that we can't go to the beach in our own country because it's owned by a bunch of really rich people?
Yeah.
It is difficult too.
I mean, I think that's the essential question, is like, how do we create a situation where, money doesn't give you more voice, right? Like, so yeah, there's always going to be income inequality. There's always going to be a difference between, until, unless we want to like really, really change things, there's going to be people that have more and there's going to be people that have less. But how do we create a situation where we keep the promise that, if you work hard and if you, do the things that we advise you as financial counselors and financial advisors, that you actually can make your life more stable, and have some sort of, stable future, protect yourself against calamity, like afford insurance, basic stuff.
Yeah.
Um,
Money was created, and like we could go down so many rabbit holes. Every time we make a podcast, we just find 5 more podcasts we should do. But money was created so that we didn't have to barter with each other. Like, I don't want your chicken, you don't want my goat. Let's create some type of tender so that I can give you this, you can give me the goat or whatever. I don't remember what I'm talking about anymore.
I know what you mean, though.
But then people were like, oh, I'm going to take that, I'm going to save it for later because I might want some more money later. So I'm going to only spend half of this. I'm going to save some for later. Yeah. And then, but if very few people have hoarded all of that value and they're not using it, it's just sitting on the books somewhere.
Yeah. Then
I think money has failed us. I think that very concept isn't working. You should, the government does make you take money out of your retirement accounts and pay taxes on it, even if you don't need it. So,
that would be a good question to put out to like whoever watches the show, or like whoever listens to this podcast, survey question, like, do you think you should be able to earn money from money?
Yeah, money is growing itself.
And if so, like, under what circumstances? So, the argument that Adam Smith makes in that, kind of thing is that as long as, you can earn money, it's fine to earn money off of money as long as you're actually taking some sort of risk, right? So as long as you're putting your capital at risk. One of the other articles that I read about in preparation for this was arguing that, investing in the stock market, investing long in the stock market is not rent seeking because you're putting your money at risk. You could potentially lose that money. And that, your incentive is to look for good companies and to think about how they're going to make money, how they're profitable, and, in the long run, and make money that way. But that derivatives, much more like rent seeking in that you're not looking to make money off of creating value. You're looking to make money off of a fluctuation in the price of some underlying asset, like a stock or whatever. And I thought that was really interesting. So, like, distinguishing between derivatives and actual, like, long investments. And I feel like, and I don't know if this is true. This is a question for you, Katelyn. Like, do you mostly see people, like, do people actually think about, hey, I'm putting money in this company because I think they're a good company and they're doing, I guess you do in ESG, right?
You do. Yes, you do. Because you're, if you think about, it's actually Warren Buffett's philosophy on investing. And I talk to a lot of people about this. I find it really interesting. Our grandparents and our great grandparents, they would buy stock certificates in oftentimes oil and gas companies, unfortunately, but we'll just stick a pin in that. GE, things like that, we knew that it was harder to buy and sell things.
Yeah.
And you wanted to share in the profits of a company that you believed had value.
Right.
Values-based investing, a company that has intrinsic value.
Yeah.
And you would evaluate the companies, not only how much money they make and but like, what types of products are they manufacturing? Do I think that's a good idea? Is that something I believe in? And then you would, like, they'd send you certificates and you would own shares of the company and you would own those stock certificates.
Yeah.
You would be a part owner of the company and you would earn the dividends. You were getting income from being an owner of the company. You were not trying to get capital gains.
Right.
We're trying to participate in the shared value of that resource. Yeah. And it was very accessible to most people at the time. Yeah. Investing is now all wrapped up in mutual funds. So very few people own individual stocks. And because everything's just on a computer, you're very removed.
It's disconnected. Yeah. Yeah. Like that old stock certificate.
Bringing it back. I think ESG is coming back around.
Yeah. And I hit when you I'm sorry, but like when you say it like that, right? It's like so quaint, right? Like, oh, how nice, and like they cared about the company and blah 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 blah. And now I don't feel like that's the case. I mean, you would know better than me because you interact with this but I don't feel like that's the case at all. Like, I feel like People are just, it's a casino. It's essentially a big casino.
And you brought up GameStop, which is something that is for financial advisors. It's just so much less interesting than people think it is. Like, I use Kylie Jenner as an example and what she did with Snapchat, because she like tweeted like Snapchat's dead. It's over. It's not cool anymore. And this tweet was like literally like 30 characters. Snapchat's value of their stock plummeted. And so I've asked people, I'm like, do you know what Kylie Jenner is going to tweet at any given moment?
Yeah.
Do you know what she's going to tweet and then how it's going to impact a certain company? And of course you don't. And I know. And so you can't know. You can't ever know. And so the way you invest money is you figure out how much you got, how much do you need, and how long do you have until you need it. And if you're 23 and you don't need that money till retirement, let that baby ride. Because what you always want to do when you invest money is you want to have enough time for the stock market to recover when it goes down, because the stock market goes up and down and you never know what it's going to do, no matter what. Who foresaw the pandemic?
Yeah.
If you saw that coming, good for you. You're the only person.
No, not me.
No, not you. I mean, like to the general, the three people.
I was like, dang, that's snarky. I wasn't really saying that.
Like, good for you, Tom. So it's like, you can't ever know. So you invest according to your risk tolerance and you invest for the long term. And that's what it is. And you buy and hold. And the people, like, I don't get many calls. I don't get many calls from people who want me to day trade, that think I like have some type of special
strategy.
That allows me to know which companies are going to do well. And I have had a lot of people that in the pandemic have been day trading just like on their own. They're just people that I happen to know.
Yeah.
And they're like, I've gotten like up to $250,000 instead of the 5. And I was like, the stock market's up 25%.
Yeah.
If you just keep, and you do need to have a skill set to be moving in and out of companies, but it's more gambling than anything else. If the stock market was down 25%, none of those people would have any money, and none of them knew the stock market was just going to keep going up. And so all those people who earn $250,000, if the stock market does very poorly, all that money is going to be gone because it's not real. You'd have to sell and put it in cash, but they still keep trying to game the system.
Yeah.
And that's the danger. That's the danger, is people that are doing things like that, because it's not
because humans are prone to confirmation bias. So they see their investments going up and they don't chalk it up to luck. And I don't want to downplay, like, there's skill involved, right? It's not 100% luck, but some of it is luck. And I think a lot of times we automatically assume when stocks go up, or when we've made those decisions, we're like, oh, I'm good at this.
Yeah.
And it's not usually not the case.
I'm having client review meetings. The stock market's up, so most people are pretty happy with how their accounts are performing. Yeah. And I'm like, now listen, I didn't do anything special because they're like, thank you, Katelyn, great work. I was like, nope. I didn't do a thing. The market's up. It could have gone down. I'm like, it's really easy to meet with clients when the market's up, because you can be like, yes, I've created this amazing portfolio for you. Like, no, it's not the case. For most people, it's trying to make sure that they're not 100% in equities, that they're putting some money in more conservative assets. You're actually reducing the rate of return in an up market, but you're investing in a well-diversified portfolio for the long term. That's what's proven to work. Is it sexy? No. Is it like, I don't know, interesting? I mean, I think it is, because it actually should be. If we're investing in companies, we should be investing in companies we believe in and holding them and benefiting from their value, not just moving in and out of companies all day, because then it is gambling. It is a game. Like, it is not what it's, that's antithetical.
Antithetical.
Am I even using that word right?
No, you are correct. It's correct. Yeah.
I just can't say it.
There are so many, I know we have like very, very short period of time. There are so many like books that I want, like, so one plug I want to make is for, not that I don't know how many people watch this, but Michael Lewis. I'm a big fan of Michael Lewis's books. So like The Big Short, but there's one that's like lesser known, and it's called Flash Boys. And Flash Boys is about the movement to get faster and faster connections to the stock market, to get to basically get an end run around. So basically, like, what do they call that? Front running.
Mm-hmm.
So the whole book is about the creation of a company whose goal was to make it so that no one could make money just by having a faster connection to the stock market than everybody else.
Yeah.
It's a really good book, and I highly recommend it. And it talks about this concept of, like, essentially large companies who would, large investment firms who would, trade on behalf of have their own channel to the stock market, trade on behalf of a client, a large chunk, knowing that the price would go up, front run it because they had a faster connection.
Yeah.
So put the trade in on the slow connection, buy it on the fast connection, knowing that they were going to implement this big trade. And
why all those firms are located in New York City. They want to be as close internet wise as possible to the hub, to the actual market.
Yeah. And that's to me, that's rent seeking, right? That's creating wealth with you've done nothing. You have not done anything that's beneficial to anyone but yourself. So we can close.
Do you have another book?
Well, the other thing, and this is any of the books, but especially I think for thinking about investments, have you ever read any of the books by Nassim Nicholas Taleb, like The Black Swan or Fooled by Randomness?
No.
He talks a lot in those books about, like, how this concept of that you're good, or that there's anyone that's really good at picking stocks is like a fallacy, a logical fallacy.
Yes, I think it is.
And so I highly recommend those books. He's a mathematician, though, so I will say that there are parts of those books where they're like right over my
head. What's the author's name? I'll just jot it down.
Nassim Nicholas Taleb.
I will Google. You will send that to me.
Sure. Yeah.
So I can link to it. There was one more thing I was going to say before we wrapped up, but this is so dumb. There are people, my brother told me about this, and I've read about it, that gamers want to be like, they're losing or winning games in cyberspace or wherever based on how close they are to the servers that those games are, where they live, not how good they are at the game. And so it's like they're moving to be as close as they can, or they're building these like supercomputers that have such power because they're going to shoot you before you can shoot them, not because they're quicker, but because their internet's better. Jeez. And so that's like, it's like, that's not fair, right? If you are constantly losing the game, is it fair that you lost because someone had a better internet connection? Like, someone could say, no, I mean, it's your own fault. You didn't get a better internet speed. Right. But they're not winning based on the principles of the game. They're winning based on some outlier, which is one of my favorite words.
I think that's a good example.
I had a thought. What was it? I was like, oh yeah, it's about gamers.
Hey, I'll take it. I mean, I think the reason why we're able to come up with so many examples like this is because it's everywhere. It's everywhere.
Well, Bitcoin was working the same way. Supercomputers, and it was just all about your speed. It wasn't, and like that's not what it was supposed to be about. So if it's about this other thing, then the system is broken, and it's so then stop trying to fix the problems the system is creating. We have to find a way to fix the system itself.
Yeah.
What a great place to end, Thom.
I like it.
So we shall wrap up here. And I'd like to thank the Community Foundation, the Central New York Community Foundation, for their generosity in supporting our podcast, even though we did kind of dig at some philanthropic theories earlier in the podcast. We do really appreciate it.
Well, it's important that they're there to get to where we need to get to, right? So
they're a part of the system right now that's actually leveraging the broken system to do as good as they can.
That's right.
Hopefully we can all work together to create a better system that benefits the many of us and not the few of us.
Yep.
So follow us on Twitter and Instagram. We're at SustainaFi. That's SustainaFi. And I'm still amazed we got that handle. And thank you so much. This is Katelyn Kriesel and Thom Delwell with SustainaFi, the Sustainable Financial Podcast. And we will see you guys really soon. We're going to start recording these more consistently. I promise my board of my nonprofit that we will do that.
Cool.
All right. Bye, everybody. Thank you.
Bye-bye.